Here's now a small video on a part of business taxation which has been missing up to now. That's part 3, the German trade tax. That's called in German Gewerbesteuer. And this small first video is just dealing with introductory remarks. So just to show you the most simple things of that tax. Well, the trade tax is, as I've already mentioned, a tax which is levied by cities, and as you see again, it's an additional tax on the type of income which is called business income in the catalog of the ESTG. So that's one of the reasons why finding the correct type of income in the ESTG is so important. If the fiscal administration can correctly classify your income as income from business, there will not only be income tax, but also additionally trade tax levied by the city. Historically, the background there is that merchants were always relatively rich in comparison to the rest of the population. So when merchants lived in a city, then the city was highly interested in subjecting them to a tax because they were a very, let's say, easy source for tax income. Well, the rules for the tax base are, although it is a tax levied by cities, the rules are nevertheless laid down in a uniform federal law, the Trade Tax Act, which is valid throughout the whole of Germany. It's generally abbreviated as I write here, so GEWSTG, Gewerbesteuergesetz. And so everybody in Germany knows that abbreviation, so please do not create individual own ones based on a translation. That only makes conversation with German speakers difficult. Well, why do we have a city tax which is nevertheless rigidly regulated by a uniform federal law? Well, that's plain and simple because otherwise there would be an enormous chaos. Imagine a firm has established several parts, several branches in different cities. Then if the city trade tax acts were different from city to city, then you would have to learn different accounting rules for each establishment in each city. That would end up with a complete chaos. By the way, the interesting thing is that within the own country, the legislator has already drawn the conclusion that when you have an integrated, uniform single market like the territory of Germany, it's absolutely unbearable to have different tax rules in the different parts of that territory. Whereas when it comes to the greater developing integrated single European Union market, it's still the prevalent and predominant opinion that every country absolutely needs to have its own tax-based rules. Seems to be a question of sovereignty, a question of God-given principles, whereas here you can see that already probably decades ago, the legislature admitted that in a comparable situation, many cities want to levy their own tax. There is only one practicable solution, that is a uniform tax act for the whole territory. Probably if there is really an economic pressure to end up with such a reasonable solution, then we will probably, well, perhaps at the end of our lifetimes, I look more to yours than to mine, see a uniform tax base and a uniform tax act with a few options also Europe-wide. But let's turn back to this. So the tax base is regulated in the same way throughout the whole of Germany. and the only thing which the city can decide about is the tax rate. Well, that's flexible enough. So if a city needs a high amount of tax revenue, then they increase the tax rate. Otherwise, they could even lower it. And naturally, politicians mostly tend or try to keep it stable and unchanged. Well, sorry, here you see it again. And now let's look to the historical backgrounds, because the computation of that trade tax is in some aspects a bit strange. For example, in former times, the trade tax consisted of 3 different tax bases. There was a tax levied on the profits of an enterprise, tax on the capital invested in an enterprise. That was a kind of wealth tax of the city. And it was a tax on the wages paid to the workers or to all the employees. So the city originally taxed all the important tax bases, which also the higher levels tax, the income, the capital invested, and, well, the income of the average citizen, wages. Now, in the course of time, what happened? The wealth tax was abolished on the federal level, and so also the capital income tax was abolished, and the tax on wages by cities were also abolished because one regarded this as additional costs, making jobs more expensive. So today we only live with the tax on profits. The other 2 components have been abolished. Now, originally, when we had still these 3 components, they were naturally not added up one by one. You had to make them comparable by multiplying them with a weight factor. Naturally, you can tax a profit of 10 million with a far higher percentage than a capital of 10 million. So you cannot just say this is 20 million in total. So there was a model where you had weight factors, and now the individual weight factors for capital and wages do no longer matter. So I just invent some arbitrary figures. But imagine the calculation would have been this: profit 100,000 weighted by the appropriate weight factor, let's say 3.5%. So we end up with 3,500. The capital invested would, let's say, have been 10 million weighted by, let's say, 0.1, would have been 1,000. And the wages, let's say 5 million wages paid, weighted by, let's say, 0.1% would be 5,000. Then all that would be added up, and that would have been 9,500 if I'm not mistaken. And this would have been the trade tax base. So that would have been multiplied by the percentage which was fixed as a tax rate by the city. Now, when these 2 other components were abolished, the tax component on capital and the tax component on the wages, naturally, the computation changed a bit because the capital component was crossed out, the wages was crossed out. So the only thing which remained was the profits. And, well, now, naturally, if you have to add one single component, then there is no need anymore to multiply that with a weight factor. And now, surprise, the weight factor was nevertheless not abolished for reasons of tradition or so. People just said, well, everybody is used to that multiplication with 3.5%. Probably it was also a kind of applied laziness. We do not want to rewrite all the textbooks and all to reprogram all the computer programs. And somebody even told me, we fear that if we abolish that weight factor of 3.5%, then a city council might make a mistake and set a completely unrealistic tax rate next year or so. So they said the best thing is just not to change things. We still keep that weight factor rule. And so we have the strange situation that the profit from a trade or from a business is first multiplied downwards by that strange factor of 3.5% at the moment, and then after it's multiplied with a tax rate which can end up considerably high. So naturally, we do that still this way. And naturally, the cities could not live with so low taxes like 3.5% times 50% or so. So the trade tax rates were very quickly surpassing 100%, and it did no damage, because if you levy more than 100% of 3.5%, well, there is still enough left over. So we came to tax rates of 200%. That would be 3.5% times 200% would be equivalent to 7% on the profit. 300% would be equivalent to 10.5, or 400 or 500% would equal to 17.5%, and so on. That was left to the discretion of the cities. There is no maximum tax rate, so especially not 100% is a limit. And so very often we have a tax rate of 400% set by the cities, which is equivalent to a mere 14% of the profit. And here, naturally, the first important remark comes in whenever you speak with somebody from abroad and you mention that you are proud your city has only a tax rate of 300%. Then you must expect that the conversation partner falls down dead from the shock. So the most important thing is probably to think what your message will do to the feelings of your business partners when you mention that, or of your potential investors. So you should directly explain, or you should say that there is a nominal tax rate of 400%, which is levied only on a small fraction of the business profit, so that this is equivalent to a plain 14% or a plain 17%, or so on. You must definitively name that this is only this and this percentage of the real profit. Otherwise, any investor will probably fall down dead or leave the country as quick as possible. Imagine you speak with an American who is a supporter of the Tea Party fraction in the Republican Party, and now you mention here in Germany there we have tax rates of 400% levied by a city. Then that person will probably vote for dropping a nuclear bomb on that city to wipe it out from the planet, because 400% tax rate naturally is horror for everybody whom you not directly pass on that message. It's only a small amount. So which tax rates can we actually find in the current years? The city of Kleve, where I live, had 411% in 2014. That was equivalent to 14.38%, has currently set a rate of 417%, that is 14.6%. It might be that due to the financial impact and consequences of the corona crisis, the trade tax rates might go up a bit during the next years, one never knows. Cologne has at the moment, 2021, trade tax rate of 475%, that is equivalent to 16.625. Düsseldorf, the capital city of the land of North Rhine-Westphalia, has set a rate of 440%, so a bit cheaper than Cologne, equivalent to 15.4%, and famous cities like Frankfurt, Maine, 460% is 16.1%, and naturally Munich 490%. You know, it's a very luxurious and expensive city, and it seems to be expensive for businesses too. Here that is equivalent to 17.15%. There are rumors that the highest tax rate which some village or so has chosen is 900%, which is really horrific, and that there are still 2 or 3 cities or villages which get along with the trade tax rate of only 200%. So a wide range, which sometimes also influences the decision of people where to locate a new branch or a new factory for an enterprise. Well, naturally, we should try to find these simple facts also in the legal sources. So let me give you the hint that you have to look for that in the Gewerbesteuergesetz, the Trade Tax Act, and that the Trade Tax Act is a tax levied by cities is paragraph 1, that you compute the trade tax base for assessment as 3.5% only of the trade profit is in 11.2, and that you afterwards apply a percentage levied by fixed by the city can be found in 16.1. And naturally, as you and me always should have a look at original sources, here is the translation. Paragraph 1, the cities levy a trade tax. By the way, look to the exact wording. There is not the cities are allowed or can levy a tax. This is formulated as if it were a duty. The cities levy a trade tax. They are evidently, and indeed they are not allowed to renounce on the trade tax and set a rate of 0. They have to levy it. Well, 11.1, the calculation of the trade tax amount starts with the calculation of the trade tax base or trade tax assessment base, which is then obtained by applying the fixed percentage of 3.5% for the multiplication on the trade tax the trade profit. Then the result of this is then in a second step to be multiplied with the city multiplier, can be found in 16.1. Okay, that I think is sufficient for the first introduction. Thanks for watching and listening, and hope to see you back soon on this channel.